There is a story unfolding quietly in tens of thousands of American households right now. A story told not in headlines or political speeches, but in the cold arithmetic of bank statements, in the slow arithmetic of years spent earning and saving, and in the startling arithmetic of what states take from you the moment you stop working. It is a story about a peculiarly American form of self-inflicted financial harm. And it begins with two words that cause otherwise sensible, experienced, financially literate retirees to stop reading, stop thinking, and start losing money. Those two words are income tax. Here is what is actually happening. Right now, as you draw breath, there exists a state in this republic, a state with roads, courts, public schools, and a functioning government, that charges retirees exactly $0 on their Social Security income, $0 on their pension, $0 on their 401k withdrawals, and $0 on their IRA distributions. No cap, no phase-out, no income ceiling above which the exemption evaporates, zero. And the overwhelming majority of retirees who would benefit most from this fact have never seriously considered living there, because that state has the words income tax in its tax code, and so they move on. They keep scrolling. They fly to Florida. And some of them, a meaningful and tragic number of them, end up spending more, not less, than they would have spent had they simply stayed put and read the second paragraph. This is not a trivial oversight. This is, in the compounding mathematics of a 20-year retirement, the difference between a comfortable inheritance and a depleted estate. It is the difference between flying to see your grandchildren and calculating whether you can afford to. The state tax decisions made in the first years of retirement do not feel significant in any single month. They feel significant across a decade, when the cumulative sum arrives not as a bill, but as a quiet absence. A room that was never furnished, a trip that was never taken, a fund that never quite reached the number you had imagined. Consider the specific contours of the problem. The three states that are extracting the most from American retirees in 2026 are not places most people would instinctively identify as tax aggressors. Vermont, that postcard of covered bridges and maple syrup and autumn foliage so spectacular it borders on the theatrical, Vermont begins taxing your Social Security the moment your income as a single filer crosses $50,000. That is the lowest threshold in the entire nation. The pension income you spent 30 years earning is taxed at rates climbing to 8.75%. Your 401k distribution, your IRA withdrawal, same rates, same calculation, same annual subtraction from the retirement you built. Vermont then closes the transaction with a 16% estate tax, ensuring that what the income tax does not claim in life, the estate tax addresses in death. A retiree drawing $50,000 from a pension and $25,000 in Social Security is surrendering somewhere between $3,000 and $4,000 annually in state income tax, in a state that also carries some of the highest property taxes in the Northeast. Vermont is a beautiful place to visit. For the retiree living on a fixed income, the beauty has a price that does not appear in the tourism brochure. Minnesota presents a different variety of the same problem. The state's healthcare infrastructure is genuinely formidable. The Mayo Clinic is not an abstraction, but an institution of genuine and irreplaceable medical distinction. But Minnesota taxes its retirees' pension income, 401k withdrawals, and IRA distributions at a top rate of 9.85%, which is among the highest in the nation for retirement income. Social Security remains taxable for households earning above roughly $84,000. A retiree with a $65,000 pension and $25,000 in Social Security is paying approximately $4,500 per year in state income tax. That is $375 per month, vanishing from the same fixed income every single month for the remainder of that person's life. The Mayo Clinic cannot treat the condition those dollars would have treated. And then there is California, the state with the nation's highest marginal income tax rate, 13.3% at the apex, does, in fairness, exempt Social Security from state taxation. But every other stream of retirement income is taxed at ordinary rates. Your pension, your 401k, your IRA, your annuity. No special deduction for retirees. No recognition that the money being taxed was already taxed at the federal level and was saved across a working lifetime precisely to fund the years when the earning had stopped. A retiree drawing $60,000 from a pension and $30,000 from an IRA is surrendering approximately $5,400 annually to California's state government. Over 20 years, that is $108,000 in state income tax on income that is simultaneously subject to federal taxation and eroded by a cost of living that has rendered the state one of the most expensive jurisdictions in the Western world. $108,000. That is not a rounding error. That is a college education. That is a decade of modest travel. That is gone. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind. But here is where the story becomes not merely instructive, but genuinely counterintuitive, and where the conventional retirement wisdom, repeated with such confidence in so many magazine articles and neighborhood conversations, begins to fail the people who trust it. The obvious response to the California problem, to the Minnesota problem, to the Vermont problem, is to move to a state with no income tax. Florida, Tennessee, Nevada, Texas. The advice arrives quickly, confidently, and often from people who have not run the full numbers on behalf of the person receiving it. The instinct is understandable. It is also incomplete in ways that cost real money. States that choose not to levy an income tax do not, as a result, choose not to fund their governments. The revenue arrives through different instruments: property taxes, sales taxes, insurance premiums structured by geography and risk, and in certain rapidly warming coastal jurisdictions, insurance costs that have become a second mortgage paid not to a lender, but to the actuarial mathematics of a changing climate. The retiree who moves from Pennsylvania to coastal Florida to escape state income taxation is not escaping taxation. He is substituting one form of extraction for several others, some of which are considerably more expensive than what he left behind. Consider Florida with precision rather than sentiment. Florida has, it is true, no state income tax, a fact enshrined in the state constitution, which gives it a permanence that mere legislation cannot claim. It has no estate tax, no inheritance tax. The homestead exemption provides meaningful protection against property tax increases, capping annual assessment growth at 3%. On the scorecard of retirement income taxation, Florida earns every point it receives. Florida's average annual home insurance cost reached approximately $8,292 in 2025, an 18% increase over the prior year, making it the most expensive state in the nation for homeowners insurance. By the end of 2026, that figure is projected to reach $8,458. In coastal counties, the number climbs further. And that figure covers neither flood insurance, which standard homeowners policies explicitly exclude, nor the separate wind deductibles that Florida policies routinely impose. Deductibles calculated not as a flat fee, but as a percentage of the home's insured value, often 2%, meaning a home insured for $300,000 carries a $6,000 hurricane deductible before coverage begins. The arithmetic that follows from these facts is not complicated. A retiree who saves $3,000 annually by escaping state income tax and then pays $5,000 more annually in insurance than she would have paid in, say, the Philadelphia suburbs, has not made a financially superior choice. She has made a financially inferior choice dressed in the clothing of a financially superior one. The clothing is convincing. The underlying reality is not. Now examine Tennessee, which earns genuine admiration on the retirement tax rankings. No income tax, no estate tax, no inheritance tax. Property taxes averaging approximately 0.56% statewide, modest by any national measure. Vanderbilt University Medical Center in Nashville provides healthcare infrastructure that is not merely adequate, but distinguished. The cost of living runs roughly 7% below the national average, a gap that accumulates meaningfully over years. Tennessee belongs in any serious conversation about retirement destinations. Tennessee, however, carries the highest combined sales tax rate in America at approximately 9.6%, and that rate applies to groceries at 4%, a tax on the most fundamental and inescapable of all purchases. A retiree spending $50,000 annually on taxable goods is paying close to $5,000 in state and local sales taxes. That figure, invisible in the headline "No Income Tax State," represents a genuine and recurring cost that compounds across decades of retirement in precisely the way that income tax costs do. Nevada presents its own particular calculus: no state income tax, no estate tax, no inheritance tax. Property taxes at an effective rate of approximately 0.49%, third lowest in the nation, meaning the owner of a $400,000 home in the Las Vegas area pays roughly $2,000 annually in property taxes. These are real advantages, and they should be acknowledged rather than minimized. The weakness in the Nevada retirement argument is medicine. The state ranks 35th nationally in healthcare access, with approximately 188 physicians per 100,000 residents. Compare that figure to Pennsylvania's 280 per 100,000. For the retiree who is, at 65 or 70, in vigorous health, the gap may seem theoretical. For the retiree who is managing a chronic condition, who requires quarterly specialist appointments, who understands that the final decade of life tends to involve substantially more medical interaction than the preceding ones, the gap is neither theoretical nor trivial. Iowa is the sleeper in this conversation, the state that deserves far more attention than it typically receives. As the result of comprehensive tax reform enacted in 2022 and now fully in force, Iowa exempts all retirement income, Social Security, pensions, 401k distributions, IRA withdrawals, for residents aged 55 and older. Iowa is also transitioning to a flat 3.8% income tax rate in 2026 for non-retirement income. The inheritance tax was eliminated. The property tax picture is not as favorable as Nevada's, running near 1%, but the retirement income exemption is comprehensive, unconditional, and without income ceiling. The winters are genuine, the metro amenities outside Des Moines are limited, and healthcare access in rural areas requires planning. For the retiree who can accept those trade-offs, Iowa offers retirement income protection that is structurally identical to Florida's and Tennessee's at a fraction of the insurance cost. And if you found any of this useful, if this kind of analysis is the sort of thing that helps you think more clearly about the decisions that will shape the next 20 years of your life, then this is the moment to subscribe and turn on notifications. Because the numbers in retirement change every single year, and the people who stay ahead of those changes are not the ones who got lucky. They are the ones who paid attention. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind. Which brings us at last to Pennsylvania, the state that has perhaps done more to earn a place in the national retirement conversation than any other, and has received less credit for it than almost any other, because it committed the singular rhetorical offense of calling its tax code by its accurate name. Pennsylvania has an income tax. The flat rate is 3.07%. Most people encounter those words and navigate elsewhere, toward Florida or Tennessee or Nevada, toward states whose marketing is cleaner even when their mathematics is not. What those people are navigating away from is this. Pennsylvania exempts 100% of Social Security income, 100% of pension income, public or private, 100% of 401k withdrawals, and 100% of IRA distributions from state income tax. No income cap, no phase-out, no means testing. The 3.07% rate applies to wages, investment income, and capital gains. If you are a retiree drawing entirely from Social Security, a pension, a 401k, and an IRA, your Pennsylvania state income tax bill is $0. Functionally, structurally, mathematically, zero. Identical to Florida, identical to Tennessee, identical to Nevada. The name of the tax is different. The amount you pay on retirement income is the same. Let a specific set of numbers make this concrete rather than abstract. Take a married couple, both 68 years old. One carries a pension of $72,000 annually, earned across 30 years of employment. The other collects Social Security of $24,000. Together, they have $15,000 in dividend and interest income. Total household income, $111,000. In California, they are paying state income tax on the pension and the investment income, somewhere around $7,200 annually. In Minnesota, approximately $6,800. In Vermont, around $5,000. In Pennsylvania, they pay the 3.07% rate on the $15,000 in investment income only. That is $460. The pension is exempt. The Social Security is exempt. Their state income tax bill fell from $7,200 to $460, a difference of $6,740 per year. Across 15 years of retirement, that is more than $100,000 in retained wealth on precisely the same income, in the same household, with the same spending habits and the same standard of living. The only variable is the name of the state on their driver's license. Pennsylvania has weaknesses that deserve honest acknowledgement. Property taxes in many parts of the state, particularly in the suburban counties surrounding Philadelphia, run between $6,000 and $9,000 annually on the kinds of homes that retired couples actually buy. Pennsylvania also levies a 4.5% inheritance tax on assets passed to children and 12% on assets passed to siblings. On a $1 million estate transferred to a child, that is $45,000 in state inheritance tax. These are real costs, and they belong in any honest accounting of the Pennsylvania retirement picture. They are also costs that can be planned around in ways that the annual, recurring, compounding cost of income tax on a pension cannot. One is a problem with a partial solution. The other is a permanent annual subtraction. Now consider the 2026 federal landscape, because the federal changes interact with state decisions in ways that reward the retiree who is paying close attention. The legislation commonly described as the One Big Beautiful Bill created a new $6,000 senior deduction at the federal level, available to taxpayers 65 and older with modified adjusted gross income below $75,000 as a single filer, or $150,000 for married couples filing jointly. For qualifying couples, that is $12,000 in additional federal deductions on top of the existing standard deduction. The SALT deduction cap, the limitation on the deductibility of state and local taxes, was simultaneously raised from $10,000 to $40,400. For retirees in high property tax states who itemize, this change is substantial. If you abandoned itemized deductions in 2017 and never revisited the calculation, the arithmetic has changed and you owe yourself a second look. Consider also the Roth conversion question, which is particularly acute for retirees between 62 and 73 who are sitting on large traditional IRA balances. The tariff-driven market decline of recent weeks has depressed portfolio values, an uncomfortable development that is simultaneously an opportunity. Converting traditional IRA money to a Roth when prices are depressed means paying tax on a lower balance, while all future growth within the Roth accumulates and is eventually distributed tax-free. The state in which you execute that conversion determines a meaningful portion of its cost. In California, a $50,000 Roth conversion carries an additional $6,650 in state income tax. In Pennsylvania, the same conversion carries zero additional state income tax, because IRA distributions, including those converted to Roth accounts, are exempt from Pennsylvania state taxation. The strategy is identical in both states. The after-tax cost is not. What the full survey of the retirement tax landscape reveals, when examined with the discipline the subject deserves, is not a simple hierarchy of better and worse states, but a matrix of trade-offs that resolves differently depending on the specific income composition, health profile, housing situation, and estate planning priorities of each individual household. There is no universal answer. Florida wins for the retiree who wants permanent warmth, can absorb the insurance costs, and lives in an inland area where those costs are manageable. Tennessee wins for the retiree who wants low property taxes, an affordable cost of living, and proximity to strong medical infrastructure in a major metro. Nevada wins for the retiree in good health who values simplicity and whose portfolio generates little investment income. Iowa is the Midwest answer for the retiree who can endure the winters in exchange for comprehensive income protection and a declining overall tax burden. Pennsylvania is the answer for the Northeastern retiree who wants world-class healthcare access, zero taxation on every traditional retirement income stream, and proximity to family, and who is willing to plan carefully around the property tax and inheritance tax realities. The decision deserves exactly as much careful analysis as the investment decisions that generated the retirement savings in the first place. The accumulation phase receives endless attention: the allocation percentages, the rebalancing schedules, the contribution limits, the Roth versus traditional calculations. The distribution phase, and the state in which it occurs, receives far less. That asymmetry costs American retirees real money, in real amounts, year after year after year. If you have a parent, a sibling, a colleague, a neighbor who is within 5 years of retirement and has not yet worked through these numbers, send them this. Not because the conclusion will be the same for everyone. It will not be. But because the conversation is worth having before the moving trucks arrive, before the new driver's license is issued, before the decision that will shape the next 20 years of financial life becomes irreversible. Drop a comment below and tell us, what state are you retired in? And what is it actually costing you? Not the headline, the full number. Those comments become future conversations, and the most common situations become the next video, because your situation is almost certainly someone else's situation too, and they are watching right now, hoping someone will explain it clearly. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.